Hello everyone. Welcome to the second part to the series on key business performance metrics. In today's video, we will learn not only about the importance of analyzing key performance metrics for the strategic management of a business, but will also continue the story that we saw in the first part to learn about the key finance metrics. If you haven't yet seen the first part of this series, then do go through the link in the description box. It will take you to that video where you will see the case study on a company called Alpha narrated to you in the form of a story. It forms the basis for this video, so don't miss it. Meanwhile, do subscribe to the channel to access free content on management concepts taught to you in a very simplistic and interesting way. Let's first have a recap of the story. So the story was about two friends, Bradley and Andy, who started a limited liability partnership firm called Alpha that manufactured and sold eco-friendly and sustainable apparels and bags made out of jute for men. The company started seeing an increase in production, sales, human resource and overall growth within a span of 5 years that encouraged them to add in more to their product portfolio. Gradually, the company grew large enough to now become a private limited company having multiple production centers and offices across their home country. The growth continued for a while before it hit a point when sales revenue and profits started declining. They were perplexed. That's when they sought the help of a lean consultant who explained the concept and need to choose the right business performance metrics to identify loopholes in operations, reasons for declining sales and profitability, and suggest improvement areas. The lean consultant suggested meeting all function heads on a one-on-one basis to discuss about department-wise key performance indicators, and today is day 1 of his meeting with the business heads. So now let's continue with the story. The lean consultant meets all the function heads and briefs them about the agenda of the one-on-one meeting, which is to identify the performance metrics for each department. He decides to first explain how measuring the right metrics will help them. He said that identifying and measuring the right key performance metrics across all functionalities will increase accountability of every employee, will help take better strategic decisions, identify loopholes, increase focus of every performance indicator, enable faster organic growth, reduce wastage due to improved focus, help control cost, and thereby improve efficiency and profitability. Post which the consultant starts meeting each of the functional heads one by one, beginning with the finance head. He asks the finance head her views about the reasons for declining sales and profits, to which she replies that the first reason would be increasing cost, both capital and operational. She goes on to explain that the return on investment on few of their products have gone down despite increased marketing expenditure. That adds to the cost as well. She also feels that the company needs to rework on the financing strategy as their weighted average cost of capital is way higher than the industry average, which means the debt equity quotient needs attention. Apart from the cost management issues and financing decision issues, the finance head feels that the company needs to work on increasing their sales revenue and improving operational efficiencies that will finally help improve profit margins and propel organic growth. Basis the discussion the lean consultant has with the finance head, he decides to go ahead identify which metrics would enable analyzing these issues. Before that, he needed to know which ones they were currently analyzing. The finance head takes the consultant through the 6 metrics that they are currently analyzing to understand the profitability, leverage, and the total efficiency. That included net profit margin, return on investment, current and quick ratio, inventory and asset turnover ratio analysis. To this, the consultant added few more metrics to be analyzed, which were EPS, gross profit margin, free cash flow analysis, and debt equity ratio analysis. he briefed the finance department about each metric and their significance. He explained that the financial metrics helped analyze the profitability, the cost structure, the financial structure in terms of debt and equity quotient, and the overall growth on a year-on-year basis that can help gauge the financial health of an organization. Starting with EPS or earnings per share, the EPS indicates how much money a company makes for each share. Calculated as net earnings upon total number of shares outstanding, it is widely used for estimating the corporate value of an organization. A higher EPS indicates greater value. Another good yardstick to measure how efficiently companies are able to make money from the products and services it produces and sells is the gross profit margin. It also helps understanding what portion of your earnings are available to cover company overheads. The net profit margin helps the companies and investors analyze if the company is able to generate enough profits from its sales and whether operating costs and other overhead costs are being managed well. The free cash flow is an important measurement that shows how efficient a company is at generating cash. It helps understand whether a company has enough cash for paying dividends or for share buybacks. It is considered as one of the most important metrics to measure the financial position of a company. The debt-equity ratio helps analyze the financing strategy of a company. That is, if the company is using debt financing or equity financing or both at varied levels. Hence, helps evaluate the company's financial leverage. The consultant suggested working on these metrics to understand the weak areas and start working on them immediately. The finance department, after working on the key performance indicators, came to few conclusions. 1. Operating costs have increased substantially against a moderate increase in sales that was impacting the gross profit. So while the sales team could work on increasing sales, the finance and operations team needed to work on reducing the operating cost by looking into their working capital and supply chain. 2. EPS went down due to a decrease in the net profit, which meant that the finance team needed to look at the non-operating costs such as interest on debt capital and other selling and administration costs. The debt-equity ratio needed to be reworked to bring down the weighted average cost of capital, and finally, the cash flows from operations and investments needed to be brainstormed on to increase cash inflows and contain cash outflows. Having identified the working points for the finance department, the consultant now moves on to discussing the key performance metrics for the sales team with their sales head. We will continue this case study in my next video next week. So stay tuned, subscribe to the channel and keep learning. Thanks for watching. See you soon.